Good afternoon, everyone, and welcome to Pioneering Pensions. For those who don't know me, my name is Stefan Lodenberg, and I have a passion for pensions. The reason why we're doing this webinar series is to invite people who have done something different, challenge the conventions within pensions. And today we have the pleasure to welcome Arun Muralidhar, who has been struggling a lot and talking and selling and explaining, and finally got the retirement security bonds on the road. So Arun, welcome.
Thank you very much, Stefan. Appreciate it.
When we sort of prepared and thought about this, you said that a lot of the pension problems in the world exist because we have listened too much on theory and too little on the practicalities of it. And we talked about the capital asset pricing model as one of the reasons. And it's a good theoretical model, but it's based on assumptions. And Arun, according to you, what are those assumptions and how do they relate to the real world?
So, Stefan, you hit the nail on the head. For me, actually, the light bulb went off literally 25 years ago. I was at a conference in China on behalf of the World Bank. And funnily enough, I even found the picture from that conference as well. And I'm the Indian guy sitting somewhere there. And I just finished an asset liability study for the World Bank's pension plan, actually using a Dutch vendor because the Dutch were very advanced in asset liability management. And I'd been academically trained. I have a PhD from MIT. And what struck me was that what we were always taught in theory, and is the foundational sort of assumption in modern portfolio theory or the capital asset pricing model, is that individuals or investors maximize the utility of wealth. And that it seemed to be, a perfectly acceptable model until I had responsibility for the asset liability study for the World Bank. And then I said to myself, if allocations are liability centric, then why isn't the asset pricing model liability centric as well? And that started a quest that's taken me 25 years to get to where I am today, because what I realized was that instead of stating the objective to be investors maximize the utility of wealth, the correct statement, especially if you've been in the pension fund world or the endowment world, or even if you manage your own money, is that investors hire agents to maximize relative wealth. And what's the refinement in that statement? The refinement in that statement is relative wealth is actually the funded status, which is wealth divided by liabilities, where liabilities could be a goal or whatever you want to call it. And that's a stochastic variable. So modern portfolio theory and the capital asset pricing model, by ignoring probably the most important reason for why assets even exist, gave us a set of recommendations which I think have caused a number of crises over the years and will continue to do so unless we do something to fix it. So fundamentally, to me, instead of thinking about absolute wealth, we should have always been thinking about relative wealth, and then the set of recommendations and portfolio decisions would have been much cleaner and we wouldn't have had the crises we've had.
And Arun, when you think about defined benefit schemes, they were quite early out thinking about liability-driven investing and matching your liabilities. So what would this mean for a DC scheme? Because most of the money are now in DC or going to be in the DC. And so we probably need to think ahead. And what does good look like in DC?
Well, I'm going to correct you there, Stefan, because when we joined the World Bank's pension fund in 95, I came from a structured bond / swap trading desk. And we went around the world and asked, the top pension funds in the UK, in the US, and even the Netherlands, how they set their investment policy. And with the exception of a few Dutch plans back then, very few talked about asset liability management. And interestingly enough, even today, I don't think asset liability management is adopted as effectively as should be the case. And we've seen the problem with the LDI strategies in the Netherlands, in the UK. But there are a lot of US pension funds that don't actually have the liability sort of matching approach that I would recommend. But you raised the second question, and a much bigger one, is we've now moved people away from DB into DC. And interestingly enough, I was at a board retreat for a large public pension plan, and they had the actuary talking about, the liabilities of the fund. And I stopped him and I said, we've got a DB fund and we've got a DC fund. What's the liability of the DC fund? And I said, well, it may not be the liability of the sponsor, it's the liability of the individual. And he had no answer for it, which to me was a bit of a surprise. And fundamentally, the liability for an individual is give me a set of retirement income, a set of retirement income cash flows that allow me to maintain the lifestyle I've had pre-retirement. That's fundamentally all it is. And when you draw that as a picture, it's basically zero cash flows till you hit, let's say, a retirement date at age 65. And then after that, it's a set of, fixed real cash flows till the day you die. And so for an individual DC, a participant, that is your liability. And therefore, all your strategies have to be designed to match that liability profile.
I can understand actually, because when you're looking at DC, it's not the liability of the provider or the sponsor, but about the member. And how do you define the liability of a member when many people are different? But I was thinking, assuming we go down that road and say we would like to do it, what theory should we use instead compared to what we are typically using today, such as CAPM and life cycles and maximization of utilities?
So I wrote a paper called the relative asset pricing model. My original idea was to call it the correlation adjusted relative asset pricing model, but that acronym would not sell very well. And the whole idea was that asset pricing and asset allocation has got to be liability driven, where the liability is the set of cash flows I just defined. And it's stochastic because as interest rates and other variables change, that liability value also changes with time. And so the original paper was a very simple paper that just said, supposing we had stochastic liabilities, how does the asset pricing model change? And essentially, the capital asset pricing model assumes that the return is deterministic. That means it's fixed and it's known. So that's why the risk-free rate in CAPM is the treasury bill, and it becomes so easy to use because it does, insure you against wealth deterioration. But the moment you go to the capital asset pricing model relative to liabilities, there's a missing term, which is minus L. And the market portfolio is now not the traditional market portfolio that you were taught, because now the market portfolio of risky assets includes the T-bill, which is risky from a DC perspective, and it excludes this liability portfolio, matching portfolio. So it changes the dynamic a little bit at the margin, but then all of a sudden you realize that just about every product in any DC pension, whether it's a life cycle fund, guided retirement, or even kept in cash and money market, are extremely risky from this liability perspective. Whereas in countries like the United States, if you put your staff in a life cycle fund, you get protection from legal claims, right? So this really changes the dynamic dramatically in terms of saying all DC pension plans are now extremely risky from this perspective.
Yeah, what you mentioned about the US, I think it's getting more and more all over the world. It's very difficult to do something that's different from everyone else, and particularly in the US, I understand things are more driven by legislation and fear of being litigated rather than doing what you think is the right thing. Could you kind of explain then, if I would want to follow your thinking, what would I do instead of a DC life cycle strategy?
So interestingly enough, yesterday I was talking to a young lady from the UK whose pension resides with Nest. And she had written a very interesting article on decumulation. And what I told her is fundamentally these life cycle funds guarantee you nothing, right? Essentially, all they're designed to do is take you away from stocks into bonds as you age, but that neither guarantees you wealth nor guarantees you retirement income. And in a slightly humorous, but in a slightly bizarre way, your pension outcome becomes entirely a function of when you were conceived by your parents. So if you were unlucky that your parents had fun on the wrong day, you could end up with a very poor pension. And that's not how we design retirement systems, right? They need to be secure for everyone. So what we need to do is make sure that as people achieve their desired retirement income goals, although they have sufficient wealth, that there should be an instrument that allows them to lock up that retirement wealth at low cost, low risk, and with high liquidity, but with a lot of simplicity. In principle, annuities should be performing that role, but they're too complex. they're too inflexible, and they're too high in cost. And so that's why we have something missing in the industry. And that's been my passion for the last 8 years, was how do we fix this problem right here?
In your great acronym, actually, should I call it the crap? Because then people would have remembered it. But in that case, so you're saying you need a safe asset in that framework.
Absolutely.
And that is what you have developed now with the retirement security bonds.
Exactly right. So what happens is, once you go down that path of saying the asset pricing model should be relative to liabilities, the academic version of my first paper was that there's just one liability for the entire universe of people, which again we know to be untrue, because your liability is different from mine, right? Your DC liability and mine are very different, not only because of the currency difference, but your lifestyle could be different. You may drive a better car than I do. You may have better taste than I do. And so what that then takes us down is, you need an asset pricing model which then accommodates multiple of these liability expressions, where the safe asset for you and the safe asset for me are slightly different instruments, not perfectly correlated, but very easily created by governments, because it could not only solve the retirement problem, but achieve a lot of the goals that they're trying to achieve elsewhere in their overall mandate to manage the economy. And so that's how this idea for retirement security bond came about, was we have a missing instrument. I used to issue bonds for the World Bank back in the early 1990s, where we could change the structure to make it appealing to investors. And that essentially is all we did in coming up with this idea for retirement security bond, is let's create a highly liquid, very simple bond that could serve as the safe asset of retirement, so that now you could start to pick that bond early in your life cycle and lock up your retirement income, and not be susceptible to changes in market variables as you get older and older.
The question I have then is, okay, we have the safe asset. Every one of us have different safe assets. Right. And then when you look at the risk assets, you just put the pricing model relatively your safe asset, but all the risk assets have the same kind of characteristics, more or less. It's just depending on your safe asset, you're going to value them differently to achieve your goals. Is that how your pricing model would work?
Yeah. So essentially, maybe I'll take one step back to explain the retirement security bond, so that people are familiar with what I'm talking about. And I may be jumping the gun a little bit, Stefan, and I apologize. But the idea of the retirement security bond was extremely simple, that the government issues a bond, and we can discuss whether the government is the right issuer or not in a second. But the government issues a bond that pays you nothing till you get to 65, which is the retirement age in any country. So if your retirement age in your country is 60, the bond doesn't pay till you get to 60. And then at that time, it pays you £10 real per year for 20 years, where 20 years is the average life expectancy of that country. And why did we pick these variables? We picked these variables because most people today who are in DC plans, myself included, have no clue how to calculate all the complex math behind compounding, inflation, decumulation, accumulation. So we said, let me embed it in the bond. And essentially now, if my goal in retirement, especially the young lady I was talking to yesterday, is to have £50,000 in today's purchasing power when she hits retirement, then her goal is nothing more to take 50,000 and divide it by 10, because that's what the bond pays every year, and buy 5,000 of these bonds before she retires, right? So first of all, you dumb down the whole complex retirement planning to math that, a fifth grade kid should be able to do, right? It depends on two questions: what's your date of retirement, and how much do you want? And the bond price essentially solves it out for you, and you don't have to do any further calculations. But now what you can do is, to your comment, Stefan, the market liability portfolio is the aggregate of all of these liabilities of individuals, which you can aggregate at a macro level and say that's what risky assets should be priced relative to, right? So interestingly enough, in the new model that I've written, which is a slightly extended version of RAPM or CRAPM, as you want to call it, what I do is, by taking multiple goals, I show how your asset allocation and mine can be different, because what we define as risky could be completely different assets, right? And so I took a look at what industry was doing, and the pension fund I was at yesterday has a very different definition of risky assets from maybe some of your pension clients in the UK. So why do we need to force this market portfolio, which nobody even has a clue what it is? why not go with practice and let people define their own risky portfolio? And then you can price the assets actually quite easily with this model.
When you were developing this, what I remember, we were having dinner in Washington, D.C. before COVID. I think it was just before COVID, actually. And then we discussed this a lot. And I thought your passion about it was very, very interesting, because you wanted to make it work for someone who's not a financial expert. You want to cut away the middle persons, both insurance companies and asset managers, so to say, and create something which was very simple, very cost efficient. How did you sort of come up with this idea in the first place?
So a little bit of luck, never hurts. When I started to write this paper on the relative asset pricing model, I'd come largely from a DB background, and I'd written a book with Professor Franco Modigliani back in 98, 99, saying that all these countries that have privatized Social Security and gone to DC plans are going to have a catastrophic mess, right? Because these are countries where financial literacy is extremely low. And, to take them from a Social Security DB and ask them to make their own investment decisions was just completely crazy and was going to lead to trouble. And sadly, the World Bank was telling these countries to do just privatize, privatize, privatize. And we were completely unsuccessful in changing even a single country. So I'd given up on this idea of working on pension reform. And I got very lucky that a very passionate lady by the name of Kathleen Kennedy in the United States came up to me and said, we've got a bigger problem in America, which is that there are a lot of people who are not even covered by a pension plan. This could be the person who's a taxi driver, the person who cuts your lawn, small companies. They don't even have the ability to set up a pension. So how can we help states in America set up pensions for these individuals, and what's the optimal asset allocation for them? And so that's when I started to think about, how do I help somebody who's an individual with minimal financial training and very low income very often get a secure retirement without having to pay a high fee or having to go to a finance class, or whatever. And so when I actually took Professor Modigliani's life cycle hypothesis paper, which if people haven't read, is the most brilliant paper I've read. It's designed to be read by a 6th or 7th grade student. And then you read it and you go, why did he get a Nobel Prize for this? But it's just, genius upon genius layered into it. And his whole philosophy was, the reason people save is because consumption exists from the day you're born till the day you die. But your income is only from the day you start working till the day you retire. And so you need to finance that post-retirement consumption. And so when I erased a couple of lines in Franco's famous paper, all I was left was with, this stack of cash flows that started at retirement and ended at death, which in his case, he'd assumed was 20 years. And that's when the light bulb went off, which is, hey, I don't have that instrument today. Can somebody create it? And then the question is, that instrument could be created, but then you better find an issuer who finds it attractive to issue that bond without taking undue risk, because that was my training as a World Bank bond issuer as well. So pure luck, right? Some really good people in my life who, brought me back and sort of taught me interesting lessons about retirement. And then, you just happen to have this brainwave one day, 20 years after you started working on it, that this could be the solution.
That's very inspiring. And that's also why it's good to talk to people about stuff and change your ideas and brainstorm. And that's where you get the best ideas, because you think a bit more freely.
And actually, Stefan, to be honest, after I did this, I had the luck of visiting one of my classmates from MIT, who is a very senior official in Korea, Dr. Sung-Hwan Shin. He right now sits on the board of governors for Bank of Korea. And we were having lunch, actually, I think in the same restaurant that you and I met. Many years before you and I met. And I started to draw the cash flows for him on a napkin because I was trying to explain to him what I was doing. And then the moment he said, it makes sense, I always trusted him a lot more because he had cleaned up my thesis. Otherwise, I wouldn't have graduated. So the moment he said, it makes sense, then you get the motivation to say, okay, I'm not completely crazy and maybe there's something here. Right?
I remember I mentioned this idea to Bonnie Jean McDonald a couple of episodes ago. Mm-hmm. And her comment was basically, the idea is good, but is the government the right issuer? And her argument was, and I think many see that, we have aging populations, we have low fertility rates. So we have quite a big demographic shift already within the countries. And if you add this on, it's basically borrowing now to pay later. So you might actually push the burden to the young people, which we're probably pushing way too much burden on already. What is your take on that?
So there's two elements to the question. I'm going to break it up. One part I agree with, one I completely disagree with, right? So let me start with the one I disagree with. Currently today, all these countries are issuing a lot of debt. So it's not like they're not issuing debt, and all this debt is actually already in these pension portfolios. So the fact that the existing debt is already in the pension portfolio and making these DB and DC plans very risky means that the government is going to have a problem when everybody retires poor, right? Because when everybody retires poor, who bails them out? The government bails them out. And this was the argument Franco and I made in 98, was you've privatized risk. You only privatize risk. You didn't do anything else. If people do well, they aren't going to come to you. They'll take the money and spend it and have a nice holiday. If they retire poor, they're going to come and make trouble. And these are people who vote for politicians. And so in Chile and other Latin American countries, just before COVID, as people came to retirement, they were upset that their retirement income was very low. So the fact that the government is already issuing debt, all we're saying is at a minimum, swap out that existing debt, which is risky in pension funds, for the safe asset. So you don't need to increase debt at all to get this going. But the second benefit, in addition to what I mentioned in terms of lowering risk of the system, is that governments are trying to fund infrastructure. And in the UK, I think your chancellor made a comment that he'd like to get more investment in infrastructure or pension funds. Look at the cash flows of this bond. You get the money today, and you don't have to repay it for 20 to 30 years. So all these countries that are trying to fund infrastructure and green investing essentially are getting a perfectly matched source for that investment. Now, where she is correct is you don't want countries going crazy and issuing debt way beyond their capacity because a future government is going to have to pay for it. So she's correct there. You have to have some monitor. And one of the reasons I've been lobbying the World Bank and the Inter-American Development Bank and the IMF is to have them serve as a monitor to make sure that the issuance doesn't exceed what the population actually needs, right? Now, even to that point, even at the end of the day, if you issue an incredible amount of debt, somebody said, oh, what happens if the government defaults? If you're a government official, the last person you want to default on is a retiree in your country, because they're going to vote you out of power the next day, right? You're going to get thrown out. So if you look at the pecking order of default, which typically applies more on the corporate side, but if you look at the pecking order of default for a sovereign, they're more likely to default on something like US pension funds hold or the hedge funds in New York hold before they default on a retiree in, let's say, Brazil or Chile or even the UK, right? So from that perspective, I think she's taking a very narrow view. I think there's a much more enlightened view you can take on that whole decision as well.
Thank you, Arun. And we have also a question from our previous speaker, Claude Lamoureux, when I mentioned you were coming up next, and he looked into this a bit, and he had quite an intriguing question for you as well. So instead of me repeating it, let's roll the tape.
What kind of pension will this new idea will generate? If I look at the return of bonds, especially government bonds over the long term, it's 3 to 4% lower than equity. Every 1% you don't get, that means that the pension is reduced by about 20, 25%. So what kind of pensions will they hope to get?
So I'm going to go out on a limb and say Claude is missing a couple of points, right? One is, this assumption that equity returns are going to give me a better return on bonds. That's not guaranteed. I did an asset allocation study in 1999 for the World Bank's pension. And we polled every asset manager we could find, and bank, you name it, Goldman, Credit Suisse, some that exist, some that don't. And what do you think the number they gave me was for 10-year annualized returns for equity? 9 to 10%, not off the mark, right? I've got a book that I published soon after which has that number. What was the realized return over the subsequent 10-year period? Negative, right? So we have no ability to forecast future returns. So investing in stocks from a pension perspective is risky, but it's also a bit of a gamble because we really don't know what the expected return is. What we're saying with this bond is we're not telling you to put 100% of your money in it. It's the safe asset, which means as an intelligent allocator, you shift between the safe and the risky asset based not on a Markowitz optimization, but on the funded status. And we've been arguing about funded status-based rebalancing from the World Bank days in 98. Again, it's in my book that I published in 2000, but ABN AMRO in the Netherlands implemented a version of this for their DB in 2008 to perfection, right? They were one of the few pension funds globally that didn't take a hit in solvency. So the final result you're going to get in your pension depends on how you dynamically allocate between this safe asset and a risky asset. And I can't predict it. If you put all your money in this, is that a good idea? Well, if your risk aversion is extremely high, then you better save a lot to get the pension you want. If you're willing to take risky assets and they pay you off, then maybe you get a lower contribution for a higher pension, but that's not guaranteed. So you're trading off safe versus risky. And that's how I would answer Claude's question, right? It's not saying put 100% in this asset. It's saying use this intelligently to not only create better investment products, but also to manage your portfolio better.
So replacing bonds as a safe asset in the pension portfolio, then you allocate based on what you think the markets will do and what the risk premiums are over time and your funding status.
Right. You can either do it on a view neutral basis, which is what I would advocate at the first level, which is what ABN AMRO did. And Geraldine Legwater is now the head of PGGM. She actually did it with a good friend of mine, Case Dirt. They had no view at all on stocks. So the mix of stocks and bonds, where bonds was the LDI asset, was purely a function of funded status. And this is something we advocated for the World Bank in 1998, 99. Sadly, not adopted, and I'd left by then. But you can do the same thing for equity. So there's a view neutral rebalancing. And then the game I play for my clients is I said, you can also layer on top of that a view based, right? So I take a view that I think today bonds are better value than stocks. And so the rebalancing can be intelligent at the margin. But the fundamental rebalancing between stocks and bonds, I think, should be based on funded status. And Adam Kobor and I have a paper in the Financial Analyst Journal that shows how you can do this without having a view on markets.
There's basically no one who picked up retirement security bonds, but Brazil did. So how has it been sort of convincing people to actually do it, kind of governments? And how did you get Brazil to sign up?
Innovation, is a hard business, right? Especially if you've got no financial interest in it. And so let me make that very clear. All this work that I do on the retirement security bond, I didn't patent it. I didn't put any of this thing on it. And even Professor Merton, who's helping me in this effort, doesn't have, any patent or anything like that. So it's hard. And as you know, Stefan, you've been in our business long enough. We have a saying in our company that everyone wants to be first to be second. So the number of countries that have told me get somebody else to do it first and then we'll consider it is a pretty long list. But we were relentless and we were writing op-eds for India, Turkey, the US, Japan, Australia, even the UK, and presenting it, France, you name the country, we wrote an op-ed saying this is something you need to do as you're pushing more people into DC plans. And then I just got lucky that a very good friend of mine, Manuel Garcia Huiteron, who's had a significant presence with NetSpar and others, was with the Inter-American Development Bank. And he saw this idea and liked it. And he said, this is something critical for Latin America. And had me speak to a group of Latin American regulators, and then had the Brazilians invite me to a conference in November 2019. And again, pure luck, right? It's amazing what luck can do. Just before the conference, I get a call from the Treasury office saying, can you come and meet us? We'd like to look at your, discuss your presentation. And the gentleman I met at the National Treasury, Paulo Valle, happened to have not only responsibility for the private sector pensions, but had issued debt for Brazil before. So within about 5 minutes, he got it. He said, this is trivial, right? I've issued debt and I know what I need to do to improve the private pension system. And then unfortunately, COVID intervened, so we lost a couple of years. But in January of this year, they issued a really amazing version of our original design where they customized it to the local conditions. But they took the enhancements and innovations a couple of steps beyond even where we had imagined it. And we just wrote a case study yesterday about, starting from idea to execution. How did the Brazilian Treasury go for it? So I just got lucky that I had one dedicated government official who got the vision. He bought me lunch as well. So that's the only payment I got from that idea. And as we discussed it over lunch, I realized he was far ahead of me in doing this than I was. And so we just helped them along the way and provided advice. But the bulk of the innovation came from the Brazilian National Treasury officials and the central bank and the stock exchange officials. So credit to them for doing that.
Is this issued by the government and then people go and buy it from the government, or is it issued in the market and insurance companies buy it and resell it? And how does it work in practice?
So from a theoretical point of view, what we argued is you need two issuances. One is that you have to have an institutional level issuance for insurance companies, asset managers, and the like. And we'll talk about that a little bit, because you made a comment saying I wanted to get rid of them. No, I don't want to get rid of them. There's a good place for them to play. And I'm an asset manager, so I have to be careful I don't write myself out of a job. But then we also argued that you need to have a retail version. And so what Brazil did is they said, rather than worrying about a big reform, let's create the retail version, because they already had what's called a Treasury Direct facility, which is you can buy government bonds directly from the government, which the US has, and in a way the UK has with the NSNI, right? The National Savings and Investments window is actually a way for you to buy government debt implicitly. They had a very active inflation-linked market, very well established. And so how it works is you can just create an account on this Treasury Direct website. It takes all of 5 minutes to register. You have to be a Brazilian citizen, unfortunately, because otherwise I would have bought it. And you enter two questions, three questions. My age of retirement, my date of retirement is X. I want so many, Brazilian real when I retire in today's dollars, and I have so much to invest. And just by answering those questions, it comes back and says, you can buy X number of this bond, which is the correct bond for you. So that's a set of questions everybody, including a taxi driver in Brazil, can answer. And what's nice is you can buy it in slices of as little as maybe 4 pounds at a time. So literally you could have a taxi fare, or you cut somebody's lawn, they pay you 40 pounds, and you take 4 of that and you say, let me buy one thin slice of retirement income at a time. So they really opened this up and democratized it beautifully so that anybody with access to a cell phone or a website can buy themselves retirement income, and they don't have to be part of a formal nest or a big fancy sort of organization to get a pension locked in. So buying the bond basically buys you a pension system as well. And the second I'll just finish on two additional features which I think are very useful. So one is they've eliminated the cost of trading. Two is you can actually put it back to them. So if at some point you change your mind, you can actually return it to Treasury, because there's liquidity, which is a very, very valuable facility. But because they want you to hold it long term, the fees and the penalties that you might pay are scaled depending on how long you hold it, right? So if you're trying to buy it on a speculative basis, the fees will eat into that profit. Whereas if you hold it to the long term, you get the benefit of, I think, zero custody costs and beneficial tax treatment. So very, very intelligently designed at so many levels that they really checked off a lot of boxes.
I was just wondering, have you seen what the uptake is? How many are people buying this, or is it more like it's a nice thing, but people don't find it?
So actually, two interesting things happened, right? One is I have a client who is Brazilian, who is a former trader from Brazil. And two is my son works for Citigroup, and they've got obviously Brazilian traders. My son was getting a lot of thank you notes from his Brazilian trader friends, which told me that they had priced it correctly. So there was no subsidy. It was market-based pricing. And so also with my client, who's a very, very sophisticated trader, saying that he and his family were going to buy it. So that told me that they had priced it purely on a market basis, and there was no hidden subsidy. In the first 3.5 weeks, they got 20,000 people to buy this bond. Okay, which is a pretty amazing number, because if even 10 of those were uncovered, essentially what you've done is for people who are uncovered, you've now provided a pension system. In our paper, we actually provide the demographics of who bought the most, actually. And what was surprising is a lot of young people bought it, because Brazil had a superb social media campaign targeting, the influencers on social media to go out and explain this before they launched the bond. So a lot of young people bought it. And then a lot of people in the 40 to 59 age group have bought it as well. The part that I'm a little surprised hasn't had more take up is the slightly older folks. And I think that maybe because they had such an active social media campaign, that maybe we miss the people who don't focus that much on social media, and we need to have a different campaign for that group as well. So I'll send, if anyone wants, I'm happy to share the paper, which has very interesting graphs and charts comparing pre-issuance what the take-up looked like, post-issuance what the take-up looked like. The last point which troubles me, and this is the project I'm working on currently, is the number of women who've participated in this is relatively low compared to the number of women in the society. And, gender equity in pensions is a big topic, but not having seen sufficient access makes me a little troubled that we didn't target the women more effectively as well.
Well, that was very positive take-up, that actually it's getting live and people are buying it, even if it's not coming through sort of a mandatory approach as in most in the UK and most other countries.
Yeah,
so now
hit the nail on the head. It's purely voluntary. Thank you. Yeah.
So now I would like to open it up to questions from the audience, actually, because part of doing pioneering pension is to let everybody who's in listening asking their questions to Arun. And we have a couple of questions in the chat. One is from Chris, and it says, so in the UK, it looks like annuity index-linked gilts with deferred period. So basically says it looks like a deferred inflation-linked bond.
Yeah. Exactly. It is actually in a funny way, but with a term, right? So we don't hedge longevity risk. I have to be very clear that the term is fixed to 20 years. But the problem you have today with annuities is an annuity provider can't give you that annuity because they have no hedging instruments. And if they have to give it to you, they're going to charge you an arm and a leg. So when people ask us, you're not hedging longevity risk, isn't that a problem? It's a multi-layered answer. So if you don't mind, I'll go through it since they've raised the question. One is longevity tends to be a slightly richer person's problem, right? So when you look at the demographic data, and you've had the expert Amlan Roy on the show, so the minority communities and the poorer communities tend to have an average life expectancy that's less than the average, right? So this bond in principle covers them without them having to buy an insurance policy, which they may not be willing to hold on to. The second problem with the annuity is very often when you die, a lot of people worry about, I can't bequeath anything. With this bond, when you die, your children inherit it and they can either collect the coupon or sell the bond and take the principal and walk away. So what's interesting is within the richer segment of the population who have to hedge the longevity risk, I've come up with another bond, which again would be easy for a government to issue, called a longevity indexed variable expiration bond, which starts paying after you hit 85 for the small cohort of people that want to hedge their cohort level longevity risk. Or, as Professor Merton and I have argued in our paper, a well-run insurance company should be willing to take SeLFIES, we used to call them SeLFIES or retirement security bonds, from a diverse population in exchange for pretty much an equivalent pension till death. Why? Because the experience of that diverse pool should be the average life expectancy of the country, right? So if you have a well-run insurance company, they should be happily willing to take these bonds, charge a fee for their service because they are bearing some risk, and then offer life annuities at a far lower cost than you would offer today because this instrument doesn't exist. So Chris is absolutely correct. We just took the principles of an indexed annuity and I just said, listen, why not have it in a much more liquid, low cost, simple instrument? And that way you can have a lot more financial innovation as well.
So actually, that was the second question I had here on my list from Larry Pollack. How do you take care of longevity? I think we actually touched upon that already.
Correct.
We have a question here from Bob. He says, Andrew Smithers, in his book, The Economics of the Stock Market, published in 2022, identified US equities that they had a real return of 6.8% per annum over the last 150 years, which is typically a 3-4% excess of gilts long-term return. So I think this comes back to the discussion when we actually said, and when Claude asked you the question, if you start buying these bonds, yes, you're kind of safe, but aren't you giving up a lot of the sort of expected return, particularly if you're a young person?
So again, it's a great question. And my answer is, if I was sitting in 1922 and I knew that data, I'd say 100% stocks, forget about my bonds, right? I'm not. I'm sitting in 2023 with balance sheets of central banks highly inflated, if I'm a 50-year-old, I'm 57 today, I just turned 57 a few months ago. Am I going to put my assets in stocks because somebody said that over the last 100 years, we got a 3.5% expected real return over stock bonds? Probably not, right? So it's very specific to the condition you're in. And that's what I mean by view-based tactical rebalancing. Now, remember, I never said put 100% in these bonds. Maybe if you're young, and that's what Adam Kobor and I show in our paper, it's a function of what your funded status is at every point in time, which never existed before, by the way. We always had a good metric of what a funded status of a DB plan was at any time. I've never seen a paper before on what should be your target funded status in a DC plan if you're 27 or 33. And so we again took Franco's beautiful paper, the life cycle hypothesis, and said, let's put a target funded status path and then rebalance between stocks and bonds based on how much risk you're willing to take, right? So again, the question ignores the fact that some people who are very risk-seeking may put 100% in bonds, in stocks, and I don't have any problem with that. But if you're risk-averse, put me 100% in bonds. If I'm willing to save more, it's a trade-off between how much I'm willing to contribute and how much risk I'm willing to take. You can't just say naively put everything in stocks. And this is the other problem I have with target date funds. Professor Merton uses this beautiful example that it's like walking into a shoe store, and the average shoe size of all the people looking to buy shoes is 7. So you give everyone 7 shoes, right? How many people are happy? 0, maybe 1, right? Target date funds are such a blunt instrument that switch between stocks and bonds on this naive assumption that there's an expected risk premium that you'll capture. And remember, in a DC system, you have only one lifetime to capture that. There's no room for error. In a DB plan, yeah, you can, there's intergenerational risk sharing, so you can pass on the risk of being wrong to the next generation. So people who talk about the expected risk premium have to remember it's expected. And the idea of the risk premium needs to be rethought if you believe my first point about we need to look at a relative asset pricing model, because it's relative to what that matters. It's not in absolute sense.
Well, then, Arun, one question that comes up in my mind is that if you're faced with this and you say you are in a pension fund like the one you visited earlier, and they have a broad diversity of members, and most of the members, they are sort of out enrolled into this, so they don't really have to think about pension, they just end up there. And the trustees have to sort of figuring out what is a good average risk aversion, and then build a model after that. Then you're going to end up having a lot of people who you miss, so to say. What do you think about applying your thinking where people have different risk preference or different goals? And then you have to do it like for a larger audience where the trustees have to sort of figure out what would be a good plan for most people.
Yeah, so that's again a challenge. But what I would argue, and I've been in fintech now for 20 years, because my argument was this entire pension business is way beyond the capacity of even somebody like me surrounded by people who are equally talented, if not more talented. And I learned this actually at JP Morgan, right? So I go to JP Morgan and I got a nice pay increase from moving from a pension fund to JP Morgan. But none of the people at JP Morgan were any smarter than the people at the World Bank. But what they had was very good process, ostensibly on Excel spreadsheets, which was backward then. But with today's technology, you can have extreme customization. In fact, Professor Merton, with Dimensional Fund Advisors, where he's the resident scientist, has built a platform where you can literally customize for each individual's salary, risk tolerance. You've got ChatGPT telling you what type of risk tolerance you have. It knows more about your risk tolerance than you have. My son wrote a paper on converting Kahneman and Tversky's questionnaires into a much more individual specific risk tolerance. So we have techniques by which we can easily customize. Technology allows mass scale customization. And at the back end, you can aggregate all of this and trade it once. So you don't have to do 10,000 trades if you have 10,000 participants. You can literally do 3 trades for the entire group. So I think there's this misconception about customization at the front end, and therefore it's going to be a mess at the back end. You can have extreme customization at the front end, which I think Professor Merton pioneered probably 10, 15 years ago with his, I think it was called Nest Pension or something to that effect. And but it hasn't had enough take up because he didn't have the safe asset to use for rebalancing. So he could only start to protect people when they got to 55. But look at his product. From an American legal perspective, it's potentially a risky product because he's not doing the classic target date, which is going from a stock into a bond portfolio. So in a weird way, he's being penalized for trying to do the right thing. So I would argue you can do extreme customization. The board can have high level oversight. Clearly, the board should have intelligent people supporting them in making these decisions. And then you hold the vendor accountable to results, right? So today, when I'm in a target date fund, my vendor is paid only to rebalance between stocks and bonds, which has zero intelligence involved in it. Why am I paying a 10, 20 basis point fee for moving between stocks and bonds when I got a year older? Let's pay people on outcome. And so to your earlier point, Stefan, my point is this allows a lot of innovation for asset managers and insurance companies, but we should pay them on the outcome they generate. And there, as a trustee, you've now done your work. That is, if somebody didn't deliver, don't pay them. If they didn't deliver a retirement income, they were going to guarantee at the front end. So we have to change the dynamics of the industry completely.
Yeah, that would be an interesting future. Particularly, it's good to sort of think about what can a new framework do in the way we look at things, and how do you reward people? Are you rewarding people for the right thing? And I think when you talk about governance, that is the number one question.
Exactly.
We have a question here from Chris. He says, retirement security bonds has a long duration, so the market price could be very volatile if you want to buy it, or when you want to buy it and then when you're selling it back.
Exactly. So the first thing is, Chris is correct. He's looking at it from a CAPM perspective. But that's the wrong perspective. You don't care about the wealth, right? You don't care about the price. As you start to lock in your retirement income, realize that what the Fed did yesterday, right? So the Fed, in a matter of minutes, the Fed and Yellen, I guess people are now blaming Yellen for the markets doing what they did. But in a matter of a few minutes, they raised the price of retirement by 1.5% on the 30-year bond, right? So if you were buying the 30-year bond to hedge your retirement, you just got 1.5% less retirement income in a matter of a few minutes, right? But if you had held my retirement security bond, guess what? There was no change to your retirement, right? It got more expensive to buy it, but whatever you bought already is completely locked in. Whatever happens to the stock market, whatever happens to interest rates, whatever happens to inflation, you don't even have to forecast inflation now as a DC participant, right? So we're looking at two different perspectives. The moment you go into this paradigm, your 401k or your DC plan statement shouldn't even report the wealth, right? It should only report the retirement income that's guaranteed and the balance amount which you could convert into retirement income at today's prices. Sure, high duration means that price is going to jump around a lot, but you have that risk already, because when you come to retirement, and you suddenly decide to annuitize at 65, you're putting all your risk on that one day, which is way riskier than having bought little slices all along. That if you change your mind about your date of retirement or the amount, you can put back to the government, right? So if the price has gone in your favor, maybe you want to sell it and say, I'll have a slightly, more interesting lifestyle from a lower guaranteed retirement income. So it's not a risk, it's actually an opportunity in my mind to have that volatility. But the beauty of it is your income doesn't change. Whereas in your current DC plan, what the Fed did yesterday is it just made you a little bit, more interesting in terms of what your asset portfolio did, right?
And I think the big challenge here is that it's about the framing, right? You do have a regret risk. If you buy it and forget it, it's fine. If you say and look, oh, if I would have bought it today, it would have been cheaper, or if I bought it yesterday, it would have been cheaper. So I think that is also playing a role psychologically.
And that's human nature. We'll never change that, right? I don't care what innovation somebody comes up with. You and I will always regret the fact that we didn't buy Peloton and Tesla right before COVID, right? And that we didn't sell it at the top. Every cocktail party you go to, everyone tells you about all the brilliant trades they made. Nobody comes and tells you the idiot they were, when they bought the wrong asset. I'm terrible at trading my own money, even though I do it for professionals, for a living. Why? Because I just don't have the time or the interest to trade on a daily basis, right? Because I'm sure I'll have regret and it'll, drive me nuts. And I'm right in my business, maybe at best 55% of the time, right? At best, right? I used to teach students and I used to tell them it's a good thing you're not pilots or doctors, because imagine if you went into your cockpit or you went into your operating room and you told your client, don't worry, I'm right 55% of the time, you'd be wiped out. In our business, that's a pretty good set of odds to have a successful investment business. So I think people need to be careful that that regret factor you can't have. And I think that's why Brazil has done a good job of trying to get young people in early, start to build it in, and kind of like a build it and forget it auto sort of investment. I don't like auto enrollment and auto escalation blanket, but I would have it like as an auto invest as part of this rebalancing program.
Thank you, Arun. We have a question from Bob here. He says, RSBs, so retirement security bonds, could be a very useful asset for retirement CDC pensions in conjunction with an equity portfolio, giving better certainty on CDC pensions in payment.
Absolutely, right? So in fact, one of my jobs is I'm on the academic advisory board for PGGM, which is the second largest Dutch pension plan and provides investment services to the healthcare workers' pension system. The Netherlands, as you know, is going through a big sort of move away from what I thought was a very good DB to some variation of DC. And so CDC is an option being considered. If I didn't have this instrument, I'd have some real concerns about CDC. Why? Because with CDC, there's again a lot of intergenerational sharing of risks. But in a DC plan, the sharing of risk becomes a lot trickier than in a DB plan, right? So this instrument could actually help individuals hedge themselves out so that the pool as a whole doesn't take a lot of risk. And then to this, to Chris's comment, or was it Bob? I'm sorry, I forgot. Then you could have equity as the balance. And then depending on how funded you are, either as an individual or as a group, you can actually change your equity allocation dynamically. So, but without this, just holding traditional bonds and equities, you're wasting a lot of risk capacity by holding bonds, which is the wrong safe asset in the traditional retirement portfolios.
Yeah, I think this idea, there's a big debate here in the UK on CDC for the retirement phase. And I fully agree with Bob. This would be a brilliant thing to have. We just have to convince the Treasury to issue these bonds.
Well, we're trying. So we've written an op-ed, right, along with my former boss at JP Morgan, Wesley Paul, and Bob Merton. Henry Tapper very kindly covered it, and we may get some more press in the next few months, in the next few weeks. But coincidentally, my former boss at JP Morgan, Harriet Richmond, who's an MP and who heads the Treasury Finance Committee, is somebody uniquely positioned to be able to evaluate it. And so we've sent it to her office, to have a discussion. But at the end of the day, it's up to the citizens of the UK. And that's what made it happen in Brazil, right? Is I had a counterpart, a gentleman by the name of Alexandre Vitorino, who just took it upon himself to say, listen, I work for Bank Safra, and I know the bond market very well, and this is a great idea. He was just doing it for free. And he worked with the Treasury officials to make sure that the bond market dynamics were captured by them in the design of this bond. So it's really up to the people in the UK to actually lobby your government to say, listen, do this. It's good for us. And you get the achievement of your goal, which is to fund infrastructure. They've got inflation-linked gilts already. You've got the NSNI distribution channel. There's no reason why the UK can't do this. If somebody can give me a good reason, I'd be very interested to hear it. But on paper, I don't see it at all.
Thank you, Arun. And we have a last question here from Chris. He says, Arun, in the UK, sadly, the pension industry, encouraged by regulation, is obsessed with the market value and performance of a pension pot. And I fully agree with Chris. So, Arun, how do we change this perception?
Well, it goes back to the start of our whole discussion, Stefan. You hit the nail on the head. In a way, modern portfolio theory and CAPM, and I don't, those are brilliant papers and fully deserving of Nobel Prizes. So don't get me wrong. But we as practitioners took the wrong message away from that, which is wealth matters, right? And we've got to now go and educate all these regulators that it's actually retirement income that matters. That's all that really matters. And Professor Merton has been on a mission, and I really admire him because he's been doing this probably for like 17, 18 years in the UK, in any country you can imagine. He's gone and talked about how we have to change the whole metric of success in retirement plans to retirement income. And the rate of return on the assets is a completely meaningless number. All I care about is what happened to my retirement income. Has it gone up or has it gone down? Right? I can't eat returns in retirement. I can use retirement income to eat sufficiently, right? So we, in a sad way, as practitioners, as participants, as citizens, have to take it upon ourselves to convince regulators that the products that they've approved and given a sort of green light to are actually dangerous products. And if it all blows up, it's back on the government. But guess who the government is transferring that debt to? It's the individual citizens who's going to pay higher taxes, right? So there is no concept of government fundamentally, right? Everything is a pass-through. So if the government messes up, it's higher taxes for citizens. So that's why we as citizens around the world have an enormous incentive to get our governments to do the right thing, especially the regulators who typically aren't managing pension funds for a living, and teach them that this is really how we need to go forward. Otherwise, we'll end up doing bad things for our citizens. So if I can leave with one last thing, Stefan, it's a call to action to all your listeners. And I'm happy, and Professor Merton is happy to help anybody in any country who takes it upon themselves to say, let's make a change happen. Because that's how Brazil worked, and I'm hoping we have success in a few more countries as well.
Thank you, Arun, for all your wisdom that you've shared with us. Unfortunately, your feed seem to have a bad bandwidth. But I will ask you a final question, because we have asked you a lot of questions. It's time for us for you to ask the next guest a question. And the next guest will be Mosh Milevsky, and he will come in April 20 to Pioneering Pensions. So what is the question you would like to ask Mosh?
So Mosh, actually, I've interviewed him, and I really like the work he does. But he's talked about buying annuities, and he's been very successful buying annuities by taking an interest rate risk. So Mosh, here's my question for you. How can you justify the pricing of annuities if the concept of a retirement security bond doesn't exist for insurance companies to hedge their risk out, especially real or inflation indexed annuities, life annuities? Thank you.
Thank you, Arun. It was great to have you here, and I want to thank everyone in the audience for joining and for the good question you asked. And Arun, I hope to speak to you soon, and thank you very much for coming.